Hey, what's up, my friend? So, in today's episode, we have Adam Grimes. So, Adam has been instrumental, right, to my development as a price action trader. So, clearly, I'm excited to have him on today's episode. So, Adam has been trading since the 1990s. He has traded for institutions, prop firms, and even hedge funds. And Adam is primarily a discretionary trader. But unlike most discretionary trader, he actually does a lot of statistical testing, right, to the technical analysis, to the patterns, right, that he trades, so that he knows that it has an edge in the markets and it's not just random luck. Yeah. So this is why in today's session, right, we'll talk about Adam's growing up years and how he got started in the financial markets. We will talk about patterns, a ton of it. We talk about number one, the failure test pattern. We talk about trend continuation patterns, like for example, when the market is trending, many traders will wait, for example, for the price to break out of the bull flag, the high of the bull flag, before they get long. But not for Adam. He actually enter right before the breakout, and he will go into the specifics to how he does it. Then we talk about the complex pullback pattern. We talk about the snap pattern, right, which allows you to get in at the start of an entry, right, where a new trend could possibly develop. Yeah. And we talk about trade management, where to set your stop loss, where to set your targets, how to manage your trade from start to finish, all this and more. So if you ask me, it's like kind of like a mini masterclass in technical analysis, right? So if that sounds good to you, then guess what? Let's get started. Okay, so welcome Adam to the show. So before we get started, I just want to say thank you, my appreciation for you, because you have written one book, right? A book that really shaped my trading, the art and science of technical analysis. So I'm not sure if people who are watching this have read this book. To me, it's one of the most comprehensive technical analysis book that I've come across, right? Because you cover things like patterns, right? All traders love patterns, and don't worry, we'll talk more about that later in today's session. But you dive deeper into trade management, risk management, and I thought it's a very comprehensive book, right? It's packed with a ton of detail. It's not a book that you can just finish in one setting. There you have it. That's the book I'm talking about.
Right.
It's not possible to finish in one setting. It's like as thick as a dictionary or something along those lines. If I'm not wrong, it's like 600 pages. If I recall, I read it multiple times. So thank you so much, right, for sharing your wealth of knowledge. And that, I think, was written like, was it 10 years ago, like 2013?
It's about 10 years ago, which is,
there you have it.
Time flies. It's scary.
Yes, it's a fantastic. And I think the biggest takeaway that I had from that book, right, the one that really made me go, damn, maybe it wasn't written in the book, but in one of your videos where you made traders tell us to draw some random lines on the chart without looking at it, and then look at the chart and you realize how your eyes will find patterns when there are no patterns there at all. That was a very good experiment, and it blew my mind away. So thank you so much, Adam. I love that piece of work that you've produced. Thank you so much.
You're welcome, and thank you for your kind words. It's a book that I think it's really helped a lot of people, and this has been since in the decade since I published the book. One of the most exciting things is hearing about people and just accumulating the virtual stacks of emails from people saying this book was what I needed to really kind of push me over the top, and so it's been an honor. Writing the book was certainly a part of my journey because I had all of these pieces lying around. I had all of these things that I was doing. But as you know, as a discretionary trader, and we should talk about that too, there's a lot to talk about here. I found myself not always doing what I should be doing, knowing that I should do one thing and doing something else. And once you write a book, or once you start teaching in general and you tell people, here's what you should do, it's great for the teacher too, because it keeps you from doing really stupid things yourself. You'll say, oh, I read about that in the book and I can't do this thing. So it was a journey for me. It was a great thing to create that on a number of levels. I'll tell you something that I don't think a lot of people know. I wrote the book in about 40 days.
40 days? No way.
Yes.
I've written books myself, and there's no way. 40 days. Wow, that's crazy.
So what I did, I tend to have, and this is not it's not a superpower that anybody should try to copy, but I basically, with everything I do in my life, I have two settings: either off, like we're just not doing the thing, or if I do it, we're doing it all the way. And I just committed to, it was actually like 44 days or something. I committed to writing every single day trying to write about 3,000 words a day, and it was most of what I did. I wrote this, and I'll tell you more, I don't think I've ever told this story publicly. So I largely wrote this book in an Irish pub here in Jersey City, which is just outside of New York City. And the staff kind of knew me as the guy who was writing the book, and I had my corner in the pub, and they would keep me, pretty well taken care of with food and Guinness. And so that was, I never worked on anything this big. Yeah, I had to do a lot of planning, had this whole kind of like skeleton planned out, and then I just sat down and wrote the book. Now, the editing, of course, was brutal, and this was where I was fortunate to have a really top quality team of editors and people doing all the production stuff that actually made me a much better writer. I'm a very clean writer. I don't make a lot of mistakes writing, but there's still, when you have, you've written books. Have you ever written a book and written the exact same thing twice in the book? That was something that I found that I did more than once, because I have in my head, this thing is so important, I must say it. And, I didn't even realize when you're just writing, that I'd actually written it twice. And the editor was like, you do know that this is actually the same thing you wrote. And so, very obvious things like that. And then every single sentence was very carefully massaged and nuanced. So I enjoyed the process. I have since then, I've written another book that was largely designed to support this free trading course that I put out. And I've started a few other books that just have not, a book on systematic trading and a book on psychology, that just have not come together for various reasons. It felt to me that this book that I wrote, the two books that I wrote, were really like kind of in my head, struggling to get out somehow. And these others will get there, but they're not quite at that level of formation.
You need to go back to the pub, right? Soon.
Maybe that's it.
Get your drinks, get your food.
That pub is gone, so maybe I'll have to find another one where I can just camp out for a couple months.
Awesome. And I'm just curious, how long did the editing process take? You say you take about 44 days to come up with the rough manuscript. What about the editing process?
Yeah, I don't remember exactly. I could check my email here, but a long time, many months. I think probably most of a year.
Right.
Maybe more like 9 months, but it was brutal. And honestly, by the time you get, and the funny thing was that this was half what you have when you hold this book. That's half the book. The first book I wrote was twice as much, because it included a lot of statistical stuff. And again, another funny story. I don't think I've ever told some of these stories. So you go through this entire grueling process, and they send you a final copy of the book before it goes to print. And I remember it was a Sunday night. I had literally gone through that very carefully, and I was having some unease about the book, because it was a combination of, the book you have and a lot of like really heavy statistical stuff. And I was having a little bit of unease, but mostly, I'd just been fighting this battle for a year, and I was done with it. I didn't even want to think about it. And literally within 2 minutes of me putting down the copy, being done with it, phone rang, and it was one of my readers, Linda Raschke, who'd read it. And she said, Adam, I don't think you can publish this like it is. You got to go back to the drawing board. So at that point, I went through with Wiley again, and we went through the process of basically, and the book is much better for that. She was absolutely right. I would not have made that decision myself, because I just wanted to be done with it. But I really needed somebody else to say, all of this statistical work really detracts from what you're trying to teach people. And I think the statistical work is very, very important. And there certainly is a certain kind of reader. And I am that kind of reader. Like, I want to know the numbers. It's not enough for you to just tell me how this thing works. I want to see the numbers behind it. But I bet if I had given you the first version of that book, it would not have resonated with you so much. So for all of these other people, and I had probably a team of about a dozen people who were working through the book, and my friend Joe and I argued about every single paragraph in the damn book. I think most of the good things, the powerful things, dare I even say the beautiful things in the book really are the result of these other people pushing my ideas into the right direction. It's great to be able to work with people like that.
Nice. Thank you for sharing. And maybe let's take a step back, because I think I understand that you're very involved with definitely writing, music, even cooking, right? Based on the things that you share on social media. But maybe let's take things back to an earlier time when you were a kid, right? When you're growing up. What were your growing up years like? I'm curious to learn, to hear.
So I was a bit of a strange child, which will come as no surprise to anybody who knows me. I grew up very much out in the country in the middle of America, and when my family moved out there, I was, I don't know, 5 or 6 maybe, and there were no houses within. I think the nearest house was almost a kilometer away. And so the consequence of this was that I grew up very much by myself. I grew up spending a lot of time in fields and forests and learning how to, like if there's ever a zombie apocalypse, I know what you can eat around here. I know how to find water. I know how to trap animals. And so I have all of these. And now that I live in a big city, those are not necessarily super relevant life skills. But I did spend a lot of time outside. I was equally interested in music and science. And that's, I think, a little bit of an unusual tension, because we think of most people who are into music are just into the artistic side, but it was not at all clear to me whether I was going to end up studying music or science or go into the military. I had a pretty good offer from several of the armed services. Well, this is actually interesting. So I was the kind of kid in high school who didn't really go to school and didn't really apply myself. I got pretty good grades, but I never studied. I skipped school to watch cooking shows and painting shows, and just anything I'd rather do than be in school. And we have something called the ASVAB, which is the Armed Services Vocational Aptitude Battery or something like that. It's basically a test of a lot of things, but it was built around pattern recognition. And the kinds of things where, like, you show somebody, here are these pulleys and here are these ropes, and if you pull this, like, which way is this wheel going to turn? Or the things where you have, like, these shapes are colored this way, if you rotate it this way, what would it look like? And I took the test, and I completely blew it off. I just, went through the test and just, like, with intuition, just completely answered, because, why can I be bothered to do it? And then I couldn't understand why the military recruiters were showing up at my school wanting to talk to me constantly. And, it got me out of class. So of course I just did it, and finally, one time I finally asked the guy, like, why are you here so much? Cause, like, I'm not this into, like, driving a tank sounds like it might be kind of cool. I don't know, but, like, why are we talking so much? And he said, oh, you don't know. I had maxed out that test. I got 100% perfect, which apparently people don't do. And I since then have discovered, I think this probably relates directly to trading. I think we talk about, there are lots of different kinds of intelligence. And I think the idea that intelligent people make better traders is false. I've seen some very, very intelligent people struggle at trading. I've also seen some very intelligent people be successful, but I've also seen people who, by their own admission, were like, I was a very mediocre employee, very mediocre student. I'm not that smart, but they figured out the trading puzzle and they figured out how to do that. So it's not really about intelligence, but I do think that, maybe one particular kind of intelligence I'm gifted with is that visual pattern recognition. And I think that has, I've gravitated to a style of trading and maybe gravitating to new styles recently. So we can talk about that too. But I've gravitated to a style of trading that really focuses on pattern recognition and on, I think when I teach people, one of the things that I can see that's a little bit different in my head, I see a pattern, and because I've seen so many freaking patterns over the years, I see all of the ways it can resolve. And of course, I can be surprised, and I sometimes have emotional reactions when things don't go my way. But I think that I'm very aware when I see a pattern of this, like, almost intuitive, probabilistic way that this pattern is going to collapse down into realization. And I think there is some pattern recognition there that is not normal, maybe.
And I'm curious. You mentioned that you aced the test, you got 100%. So did they follow up with it? Hey, Adam, here's an offer. We would like you to join us. Blah blah blah. Is there anything along those
No,
lines?
I had lots of offers. Yeah, I had, but both the Army wanted to put me into a tank, and I was more interested in submarines. So I was talking to the Navy too, and I actually had a scholarship, one of just a handful in the state, for to join the Navy, and I put a suit on and went down to sign the paperwork to accept it. And on the way down there, I was like, I think I really want to do music, because I was also pursuing music very, very seriously, to the point where I was practicing my instrument. I was writing pieces, but I was writing music. I was spending, as a teenager, probably an average of 6 hours a day working on my music every day on the, just full time. And so that was obviously something that was very important to me. And I was literally standing there with a pen in my hand, and I said, I don't think I can sign this. And the guy was like, there are like 5 of these in this state. Like, you got one of them. We'll just sign the paper. Like, I don't think I want to do this. And he's like, well, what do you want to do? I was like, I want to be a musician. He looked at me like it was and it very likely was the stupidest thing he had ever had anybody say standing there. But that was how my life ended up following the trajectory it did through college. And I went and studied music, piano performance, and music composition. And when I graduated from college, that was when I started trading. I had no financial background, no exposure to financial markets, or one of the things that I had learned about myself in college was I really don't like casinos. I really don't like to gamble. And I know now, the few times in my life that I have been dragged to a casino, even then, I think I had a very clear intuition that the edge was against me. And I walked in college. I don't remember where it was, but I was forced to go to some casino thing. And I just walked up to a table and I put my entire bankroll for the night down on a single bet, and I lost. I was like, that's, to me, the process of playing was not fun. And I had intuited that when the odds are against you, the best thing you can do is play as few times as possible. And I happened to lose on that one. But, I think there was probably some intuition about probabilities, and which, I had no formal math education when I did start trading. And I realized, because my formal education was as a musician, so the math class that I had was basically what you might call math for poets. Like, we would learn about mathematical concepts and then kind of think about how they made us feel. And I'm exaggerating a little bit, but I had no real math training, to the point that when I started trading, and once I figured out that this was really a game of numbers and probabilities, and I built all of this for myself from the ground up because I didn't know anything. And it's like, well, there has to be some way to keep track of what usually happens when these patterns happen. What tools do I need for that? So I taught myself statistics and elementary calculus sitting on my sofa at night with a textbook and a pencil and paper. And it took a couple of years to develop the math skills that I needed. Interestingly, I was always very interested in computer programming, but somehow I had managed to do that without actually nailing down any knowledge in math whatsoever, I guess.
Brilliant. So from what I'm hearing, it's your first foray into trading happened because you went to a casino and you placed all your money on that bet, and that's where you got started learning more about having edge and stuff?
No, not really. So I knew that I did not like to gamble, but nobody in my family was extremely conservative financially, to the point where, and this is something that's pretty common with American families, that even several generations back remember the Great Depression and remember struggle. And, now that decades of prosperity, there's still this feeling of, you could lose it. So, I'm sure neither one of my parents ever had a penny in the stock market. And so I had no exposure to that whatsoever. But when I graduated from college, I got a brochure in the mail from, I don't know if he's still in, I think maybe he's on the run somewhere from tax evasion. I don't know. Ken Roberts, the commodity guy with the cowboy hat. And he had this, I forget what it was. It's maybe $200 or something. You bought this book where he would teach you. It was based on the cattle market, which ironically, the grain or the meats are markets that I've never been able to trade very well at all. I now actually have a rule that says don't trade meats, and I've had that rule for 20 years. And a couple years ago, we were experimenting with some new swing trading on some different time frames, and so I thought, let's throw cattle and hogs in, and let's see if it works, because why should I be afraid of these markets? And sure enough, my win ratio was like, so now I still have that rule back: don't trade meats. But Ken's thing was based on pyramiding into the market. So you could start with a very small amount of money, a few $100s, and buy a cattle contract that would go in your favor. You could buy 2 more, and then you could buy 4, and you could buy 6. And eventually, if the market went in a straight line, you could own tens of thousands of cattle contracts, and you could make millions of dollars starting from $100. And I knew, I didn't know much, but I knew that it wasn't going to be like that. But there's some, when you hear these, and I would say that kind of marketing is essentially scam marketing, but the copy, whoever the copywriter was for that, copy was brilliantly well written. And there was some little part of me that was like, let's buy a lottery ticket and try it. But I also, wanted to see. So I got his stuff. I studied everything. I studied his charts. And ironically, his trading approach was not the stupidest thing I've ever heard. It was based on what I call like a 1, 2, 3 bottom. So a market has been downtrending and then makes a higher low, and you look to buy it. Of course, it's, I've traded like that sometimes. Like you actually, there are isolated cases where you can get useful information from that kind of pattern. So it wasn't totally crazy, but, and I opened, this was in 1995. I think I opened a $3,000 account. Now the brokers, he was also working with brokers who charged $100 a round turn. So for me to do a trade cost $100 at a $3,000 account. I didn't understand the numbers at all. And the charts, every week I would get a chart book in the mailbox, and there would be space where I would update the charts by hand through the week, and then another chart book would come out the next week. And so that was my first exposure to charting. And of course, I don't have to tell you the story, but I started trading and lost instantly. Like, you just completely blew the account. But I would say I was trading on the daily chart. There were no real, there were mid-am grain contracts, but for most of the things, you're probably risking $1,000 a trade, and you have a $3,000 account. That math is not going to work out, and you also have no idea what you're doing, so that helps too. And I did that a few times, and I refunded the account. But there was something about this. I was like, okay, I obviously don't have any idea what I'm doing, but something about this I really, really like. There's I to this day, I can't explain what it was about that process of, I wasn't watching charts because I didn't have a data feed, but it was something about seeing. Oh, and I guess I should also mention, being the kind of research minded person I am, I went to the library and I got like old historical records, and I was making charts by hand in the library of all of these commodities back into the 30s and 40s and 50s. And I wasn't trading stocks, I was just trading futures. And so I did that a few times, and then I finally figured out that I had to learn something. I started down the path of kind of figuring things out. Bought my first charting program on went to a computer store, a physical store, and bought a charting program on, I'm sure they weren't even DVDs, they were CD-ROMs. And my early, first data feeds were, of course, a modem connection, a dial-up modem. And I just happened to be, somehow I gravitated into day trading the British pound when the Asian financial crisis hit. And I still had no idea what I was doing, but what I was trading was basically what I do now, looking for pound to make a big move, and I was trading bull flags and bear flags, and there was enough volatility in the market, and I was stupid enough to not be afraid of risk and to not understand the risk that I was taking, that I made what for me at the time was quite a bit of money. And that was how I initially got started. It was a combination of just some interest, something in my gut was like, this is a really cool thing that I like. And then I guess just enough patience and luck. Certainly, everybody would like to believe as traders, luck plays no part of it. But I was lucky to lose at first. My very first trade was, I'm almost sure it was wheat, but it's been a long time, and the market had gone practically parabolic. And I thought, well, it's gone up so much, it's going to continue to go up. So my first trade was I bought the top of a parabolic move, and I think I was fortunate that I lost very, very consistently early on. And you don't know. It was a different world then, because there wasn't the internet, there wasn't the kind of communication. You don't know who to listen to, and the broker would call and would say, "Oh, I've been talking to guys down on the floor, and they know this market's going to do this." And at this point, I'd had an account that I basically blown. There were a few $100s and left in, and he was like, "Well, conveniently, like you could buy a call." And he's like, oddly, because obviously he just figured how to get this guy to blow the rest of his account and do another trade with us. And he's like, I've been talking to the guys down in the silver pit, and they know, and he had all of these stories for why it was going to happen. And I said, my chart says it's going to go down. And he said, "Oh, okay, yeah, it looks really good to go down too. Let's buy a put." And that was the moment where I realized nobody I was talking to actually knew more than I did, and I knew nothing, and it was kind of terrifying. And I began to really understand the sales-driven nature of being a full-service broker at that time. And I got lucky and figured it out, and ended up trading basically every market there is, and it's worked out.
So maybe let's bring forward to today, right? But maybe before I ask the question, I'm curious, because earlier you mentioned that you were drawing charts by hand. They mail you a chart book. I'm not even sure what that is, because clearly I have not done it. But you draw the chart book, I guess, bar by bar as the candle closes each day. Am I right?
Yeah. So what it was is, imagine like a magazine. And because, they would keep printing costs down, so it'd be thin paper, it'd be like newsprint paper or almost like tissue paper. And you would have this chart book that would have the different months of, like the beginning of it might be, I don't remember what order. I know what order I would put it in today, but like the beginning would be like, S&P front month, and then maybe the next 2 months out, and it would be like that for every commodity. So you'd have, I don't know, probably 80 or 90 pages in the book, and they would be printed. So obviously, this is just a daily chart. Nobody's doing any multi-time frame things. There might have been a moving average or something on it. There was volume and open interest, but then they would leave space to the right of the chart so that as each day closed, you could go and draw in the bar. And they weren't even using candles. They were bar charts.
Do you feel that by doing the exercise, it kind of gives you, I don't know the word, intuition, a feel for the market, since you're doing it by hand?
I think so. And that's one of the exercises. I don't think that's the way to do it. I think a better way to do it, I have a few blogs on the topic, and I also wrote about it a little bit in the books too. I think it's a really good idea to keep some kind of swing chart. So you're doing something like, kind of maybe a cheap point and figure chart, something like that, where you decide on a reversal value and you're going to reverse the line. There's nothing wrong with drawing candles or bars on a period completion, but what I think really did it for me was doing that for about a year. I charted the S&P. I was trading 1 and 5 minute charts, and I kept this swing chart that I had all this graph paper that I had it like all around my office, and it was on top of each other. It was like snaking around the office, and but doing that, I don't know that there's any. I think what it is, it makes you pay attention, and I don't know that there's any like magical learning that it reorganizes your brain beyond the fact that it makes you pay attention for every single swing of the market. And it makes you, think about, okay, so I draw this line here. What does it mean? What did it feel like to be involved in a trade? Did I make right trades? Did I make wrong trades? What made me make those? So, you're constantly asking questions if you go through this. It's not just the matter of you're just drawing the line on. And of course, if you do it long enough, there are going to be some periods where you're just drawing the line on the chart just to kind of, maintain the practice. But I think one of the things that people really struggle with today is this quality of attention, because neither you nor I has picked it up, but I bet your phone's right there, right? And if we weren't on a call, if we weren't on a call, we would have been browsing Instagram or some feed like that. So our attention today is just so fragmented in a way that it really works against people doing. I forget who used the phrase deep work. There's an author. It's not mine.
Cal Newport, yeah.
I think you're right. You're right. I think that this idea of doing deep work, which I think is where the kinds of change that you need to provoke in your brain happen. It's just not normal for people. It's not natural. You have to force yourself into it. And that's why I think that is such a powerful exercise for doing that.
Okay. And let's say we fast forward to today, right? So what's your trading methodology like right now, your trading style?
So I'm still doing basically, I would like to tell you that my trading hasn't changed at all. So, and this is the, let me ask you, what are you doing? Are you primarily systematic? What are you doing?
I do both, actually. I run trading systems as well as having a discretionary price action on a separate account.
Okay. So my focus has been almost entirely discretionary, which is funny because I do an incredible amount of systematic work and statistical work to support what I do. Also, my trading is 100% technical. And again, it's funny because I do a lot of macro work. I do a lot of fundamental work. And when I started really doing this work in about 2005, 2006, I was learning all the fundamentals and how everything's supposed to work. And then by that point, it was getting to it was about 2005. It was a little bit harder to fool me because by that time I had developed backtesting skills and statistical skills. So, I was able to do things like, okay, so you tell me low debt on a balance sheet is a good thing. You want to look for companies that have low debt. So let's just see what would happen historically if we bought companies with low debt on their balance sheet. So I was able to, looking at this fundamental stuff, to pretty quickly see it doesn't work how people think it works. And I remember walking home. I was in New York at the time. I remember walking from the subway, just thinking about the work that I was doing. And I had found some glimmers of fundamental edges, but then it hit me that all of these edges that I found were at multi-month time horizons. And I have always been a trader. I've always been a short-term trader. When I was focusing on day trading, I traded a 5-minute chart. I traded a 2-minute chart. When I trade on the daily chart, the way I think of it is, I want to be in a trade for a few days to a few weeks. I'm not looking to hold something. Now, I also do long-term investing where, I am holding things for years, hopefully. But as far as my active trading, so I want that shorter time frame. And I realized that all of this fundamental work, I couldn't find much of it that worked very well, but all of it that worked at time horizons that were not very interesting to me. And it was like, I was walking home like 10:30 at night through Times Square, and it was like, the heavens opened and angels sang to me in a light. And that was the moment where I knew, okay, I don't have to look at this fundamental stuff. It's not really going to be part of my process. So I would like to tell you that my trading is basically the same as what I wrote in the book, but I know as a discretionary trader, systems need to be tweaked and nuanced along the way. And I know that as a discretionary trader, I don't always know when I'm making those adjustments. And I know that I've made those adjustments. Some of those adjustments are over the years. My stops are a little bit tighter. My profit targets are a little bit smaller. I don't try to hit. I've never really tried to hit home runs. I tell the story sometimes. I had a Euro trade where on part of the trade, I got 32 R on part of the trade. Just an incredible trade. However, it was a very small piece of the trade, and it was so much work to manage it. And the fact that I still remember it, and it wasn't that much money, and we're talking about it, means that it's probably more of an emotional thing than a practical trading thing. So, I tend to be a very like a trade is just a trade. Just take the pattern and see if it works out. I trade primarily consolidation patterns. I look for market to make a big move, and then assess the character of that consolidation. Look for a move in the other direction. I'm trading a little bit more around levels and on trend lines, but looking for reversals. The problem, of course, with that is by the time you have the reversal, you've already given up so much of the move that but again, what I'm trying to do is just look for a market that's, rather than thinking, it's not, my goal is not to be able to put up a chart and say, oh, look, I sold up here and I bought down here and I got the whole swing. Rather, I understand that my job is to look for a market that's making a clean move and just take a bite out of it. And so if you think about it like that, it's not really a problem that you've had the reversal and you've given up some of the move if there's enough of an edge. I have decided to, and this is something that's still kind of in the process of being done. So I went back to day trading about a year ago, and I did that with incredible. If you're going to do it, it takes incredible complete focus. And I remembered why I didn't want to do it, because I don't want to live my life staring at every tick of the screen. And so after doing that for most of a year, and then just realizing, there are good reasons that I chose not to do that. I think my next act is that I'm going to start deploying some more systematic and algorithmic approaches, which, I've traded systematically in the past. I've traded systems and massaged them from a discretionary standpoint. I've traded systems on very small size, but I've never been a trader. I would never have branded myself as a systematic trader. And, when I think ahead to the next 20 years of my trading career, and also, you get older, you don't get smarter, you don't get faster as you get older. So, the idea of being a 70-year-old day trader and pounding away, that's just not realistic. So I suspect more and more of my trading will become systematic, and that's where I am today.
So I know that for the longest time you were a discretionary trader who makes your decisions based on statistics. So I'm curious, at that point of time when you were a discretionary trader, why didn't you choose to go with the systematic approach, even though you already had the background, in doing systematic work?
I think it's hard to really understand our full motivations for anything, but I'll tell you some of the things that were kicking around in my head. One thing was that I had this idea, and I still think it's true. When I was starting to figure out trading and had some success, and then I also tell you, every single time I switched markets or time frames or asset classes, I struggled. It was like a pretty massive relearning. I would love to tell you that if you can do one kind of trading well, you can just do another kind of trade. It certainly wasn't my experience. I had the skills to learn, but I had to relearn. And I was fortunate to be able to interact with some of the grand old names of technical analysis who were still active in the 1990s. And I was very confused because everything you would read would talk about the advantages of systematic trading. And of course, this was a few decades back when the turtles were still showing pretty good performance, and we were closer to that legendary event, and it was still very mysterious. People didn't know exactly what they were doing, so there was a lot of stuff about systematic trading. There were also neural nets, which I think is a variation of a much more primitive version of the AI that we're seeing today. And everybody was convinced the neural nets were going to take over, and they didn't. And I don't think AI will now. But I was surprised to see that my discretionary trading was pretty consistently better than my systematic trading. And it baffled me because everything I read said that systematic trading was better, and I wanted to do that. But when I talked to these old systematic people, the answer I got back was some variation of, well, of course, a good discretionary trader is going to do better than a system. But there just aren't that many of them, and it's really hard to do. And if you can do it today, there's no guarantee you can do it next year. All of that's absolutely true. So part of it was this idea that I could do better as a discretionary trader than a systematic trader. Part of it was maybe also just a little bit of arrogance, like if I certainly understand that from a systematic perspective, like you built that system. There's a lot of work there, but it's a little bit more of a cowboy thing, to go in and like you see the pattern and you make the trade, and there's a feeling of like I did this with my own hands, and I think that was very appealing to me, and maybe also just some inertia. Once you trading, I think is long-term trade. I'm careful with what I'm saying here. Having a long trading career, not long-term trading on a long time frame, but having a long trading career, I think is really a delicate balance between consistency and innovation. And there definitely is, I've looked at some very, very strange ideas. I've looked at some ideas that are so strange we can't talk about them. But I also, when it comes to what I actually deploy, I'm pretty conservative. I'm going to deploy things that have worked for me in the past and things that I'm comfortable with. So I think it was probably just a little bit of inertia, is what I know.
Given what you've just said, and then as you've said earlier, in recent times you're starting or considering to make the shift to systematic trading. So what prompted that, this transition that's in your head?
Thinking about it's a different workflow. I think if somebody says, oh, you do both, so somebody says, what's more difficult, systematic or discretionary? Well, they're difficult in different ways. You put the work in different places. And I think, if you are it's quite difficult for me to, just in the interest of full confession, it's difficult for me to trade and do anything else. Even if I'm trading on a fairly long time frame. Say I'm trading 4-hour charts. If I have a bunch of trades on a 4-hour chart or potential trades, and I'm trying to make a course or write a chapter of a book, it's very difficult for me to do. The market takes my focus in ways that I can't really multitask. I think multitasking is largely a lie anyway, but that's a separate discussion. So what is attractive to me is the idea of being able to put my systematic work in like mad scientist mode and do the development, and then be able to step into a very arm's length risk manager role while the system actually runs. So it's not a desire to spend less time trading, but it's a desire to be able to put that time into different spaces, which will then into different slices of the day or week, which will then let me do other things that I want lifestyle wise. And I've tried to do this several times, but as I've said, inertia is a powerful force, and also the conservatism of knowing what I'm not an expert in how anybody should trade, but I'm an expert in how I should trade. I know what works for me, and the idea of changing that in a very significant way, it's going to take some work. But I can do it, and I like the challenge, and I like doing kind of crazy big things. So I'm looking forward to the challenge, but just being fully open about knowing that it is going to be a challenge.
Okay, so maybe we can talk more about systematic trading in a future episode, right, when things are a
Sure.
little bit more finalized for you. But for today, let's keep
Yeah.
it to discretionary trading, since that's where your wealth of experience has been at, right, over the last 10, 20 years. Yeah. So
Sure.
I think in your book, right, you mentioned, if I'm not wrong, 4 particular trading patterns. We have the failure test, the trend continuation, the complex pullback, and the NT pattern, right? So I think maybe I'd like to go through this. I think in the book you covered it pretty well, but sometimes during podcast conversations we can dive
Sure.
a little bit deeper, certain nuances that we might not have read in the book. So let's
Sure.
go with maybe the failure test first. I think that's a very prominent pattern that you have spoke about in the book. So maybe for the audience who are listening, you can just give them a explanation of what the failure test pattern is about before
Sure.
we dig in deeper.
So I'll also tell you that I have been doing a series of pretty extensive talks, some of them, one of them was almost 4 hours on each
The
chapter.
Hudson sessions.
Yes,
Did I get that right?
sessions. You did.
I've
Yes.
been paying attention. Yes. Okay.
And I do talk about these with those slide decks have hundreds of charts, hundreds of examples, and I talk about how my thinking has changed in some minor ways on these. But in reality, my thinking, the market hasn't changed, and my thinking about these patterns is not radically different. So the failure test is a good place to start. The failure test is people also might know this as like Trader Vic's 2B trade. You have a market that has defined a clear resistance level, and I think that's that's kind of requirement number one. It can't just be some random level that you pull out of the middle of some previous candlestick or some of the stupid things that you see gurus do on YouTube. They're just pulling levels out, and that's not a level the market sees. It has to be a level the market sees. And what you want to have happen there is the market trades up through that level and then reverses back down below. So what the market has shown us is that there's really no interest in buying above that level. We went up there. The bulls had a chance. They failed, hence the name of the pattern. And there are different ways this can show up on a chart, but that indicates a minor exhaustion above that level. And it's a really good spot to initiate a trade. Your risk. If you're right, the pattern accelerates in a very gratifying way pretty quickly. And so it's not a kind of trade where you get into it and you have to sit there and wait and wonder. If that happens, the trade's probably wrong. So it's a good trade. It's the first trade. It's the first pattern I put in the book, which is probably why you started there. I don't know that I would suggest that beginning traders start with it, because obviously I thought at one time that they should. Maybe I was right, but I think the danger of the failure test is there are really two things. They're not all that common, so you'll find yourself looking. Trying to force the trade. This is how you'll get into using those kinds of suboptimal levels. Great way to do it might be if you were day trading, like just use the high and the low of the day. So you have some for whatever market you're trading. So you have a clear level. The market's already shown. Everybody knows when we go to a new high. If you go to a new high and fail, it probably says something. The other problem with it, though, is that it locks traders into a counter trend mode, because that market probably was going up to make that new high. So we probably had some kind of uptrend. Now, of course, trends end, and there's certainly good trades to be made around the ends of trends. But I see with developing traders, there's this, people get so cynical, and I'm the most cynical person on the planet, so I understand. But they'll see any price move and they'll think it's wrong, or they'll just have a desire. The market's going up, so they're just shorting into it. And you can trade like that, but it's probably most traders when they begin would probably do better to orient themselves toward aligning with whoever's winning in the market. So I think there's a little bit of concern with that, but having said that, it's a great pattern. I just tweeted yesterday a pattern where this happened at the bottom. So what's really nice is when these line up with other patterns. So we had a case where the market made a pretty big move on an intraday chart and then made a flag, and there was a failure test at the bottom of the flag. So that's a really nice trade, but that's a trade that benefits from like these kind of multiple layers of interactions that feed into the pattern.
So I heard you say that to trade this pattern, one of the key things to look for is to make sure it's of a appropriate level, right? Because you don't want to just trade off any Tom, Dick, Harry level. And then
Right.
for day traders, you talk about the intraday highs and lows. So what about someone who, let's say, trade off the patterns on a 4-hour or daily time frame? What are the kind of levels that they should be looking at? I'm probably thinking 52-week high, 52-week low, etc. But
Well,
still,
those are good.
would
Those are
love to
good.
hear your thoughts.
Yeah. One level that I suspect we're going to be talking about very soon in U.S. stock indexes is all-time highs. A failure test at an all-time high is a real. If it's not a signal to get short to you, it's at least a signal to ring the register on some longs that hopefully you've had for a while. So it has to be really obvious, and it's the kind of it should not be a level that you have to explain to somebody. If you imagine somebody who has just been trading for 2 days and they just learned the basics of reading charts, and you give that person a chart and you say, point out the important levels. They should be able to do that, right? It should be that incredibly obvious. So, it'd just be like significant highs and lows. Imagine an extended trend. A really nice thing is if you get like a little double tap of a top or a bottom or something where, maybe you have a parabolic move and then the market comes off and then goes back up and fails above that. So you have those kinds of, variations of double tops. Those can be good. It just needs to be a really, really obvious level.
Okay, and maybe just to push back a little bit, so obvious levels, like let's say for example, a 5 minutes time frame, that level can be really obvious. But when someone goes to, let's say, the 30 minutes or the 1 hour, that might not be a very obvious level already. So I think there's a little bit of a disconnect there. So I'm pretty sure you have an answer for it. So I would love to hear, what's your take on that?
You're absolutely right. I mean, you can pull up a very obvious 5-minute level is invisible in the 30-minute chart, perhaps, right? It's just in the middle of the bar. It never happened. But here's the thing. What time frame are you trading on? So you're going to put that trade on based on the 5-minute chart. You're going to manage it based on the 5-minute chart. And so I think a lot of the multiple time frame analysis is useful, but it's also potentially confusing. It's something that I find I don't actually do that much explicit multiple time frame work now. I can pretty much look at a single chart and have a pretty good idea what's going on other time frames. My day trading, I do explicitly use multiple time frame charts, but the way to untangle all of that is just to make sure that your analysis is on the time frame you're going to trade and that you're not taking information from another time frame.
Got it. And also, I think just to backtrack a little bit, you mentioned a little bit about the how there's was it a bear flag pattern that was formed on an intraday basis followed by a failure test. So correct me if I'm wrong. So I'm imagine that there's a downtrend, a bear flag has formed, and then the price tried to break down lower, testing the lows of the bear flag, and we got a failure test. Was that what you were saying earlier?
So it was a bull flag. So
bull flag. Okay.
It was a bull flag, and it was a complex flag. So it came down and made 2 touches at the bottom, and that second touch of the where it touched that previous pivot. So the market goes up and then comes down, makes a flag, tries to rally. Now it's left a pivot down there. And then when the market came back down to that level, it made a failure test with very good momentum. So that was a good buying sign. It was a buying failure test. It was at the bottom of a bull flag, and then that led to it's people won't know when they hear this in the future, but we just had a gigantic historic rally day in the U.S. stock market, and that failure test off of the bottom of that little 5-minute flag was an entry that set you up for this entire big move.
Got it. And that sounds a bit similar to the complex pullback pattern, which I think you covered in your work
Yes,
previously.
it is. It is. Not every complex pullback will have a little failure test at the bottom, but when you get it, it's a really nice trade.
Awesome. And so maybe just a couple of more questions on the failure test. So, failure tests, there are a few things to look for. One, we talk about, finding the right level. What about looking at how the price approach a level? Because there are many ways a price can approach a level, right? Sometimes, strong momentum, big candles into it, and some could be just very choppy, higher highs, high lows into a level. Is that up for consideration as well?
Yeah, I mean, I think it's a little bit difficult to teach, but one of the things that maybe the biggest thing that I am aware of is kind of the character of the market and how the market is moving. And that's something that in these, when I have a captive audience for multiple hours in the Hudson sessions, I talk a lot about what I see in character and I try to quantify it. One of my frustrations with the way a lot of the stuff is taught is it is difficult, it is complex, but sometimes it's left so that it's so complicated, like, oh, I can't explain it to you. It's like, it's just something I see. And, if you sit in front of the screen for 8 years, maybe you'll start. That's not a very good way to teach. And it's not realistic. But what it really is, it's a lot of little pieces of information. And all of these pieces of information kind of have to be balanced against each other. And you do have to build your own way of thinking about the market, looking at the market, and the way you understand the market, and the way you see the market will be, like you've told me that you absorbed a lot of my stuff and a lot of my stuff helped you a lot. But I guarantee if you and I look at a chart, we're going to come to different conclusions a lot of times. And by the way, we might make different trades. We might both make money on the trade, or we might both lose money. But as a discretionary trader, you have to internalize this. A lot of it is, I'll assess the character of the market as it's moving up to that level. For instance, what I don't want to see is, let's go back to that example where we had a parabolic move up, and then let's say we're looking for a failure test back up at that old level. So what I don't want to see is the market like grinds back up there and then goes flat right below the level. That's a setup for a really good breakout trade. So I'm going to tell you that if I see that, I'm probably not that interested in a failure test. However, now if it does make a failure test and then reverses, if the character of that move could be such that I completely reverse what I told you 8 seconds ago, and I say, oh, that is a good failure test because it was a good consolidation, good setup for breakout. It really failed. Let's take the trade to the other side. So it's very, very difficult. I would say impossible to give you an exact set of rules. But what I think I can do over showing you, many, many examples and talking about the elements, you can start to see how I'm putting the puzzle together and figure out how to put it together for yourself.
Yep, those are really insightful. So thank you for that. And one last question about the failure test. So at failure test, we have all sorts of sizes of the candle. Some can have a huge candle, which is maybe 3 ATR, and some maybe a really small, which is just 0.5 ATR. Well, what's your take on that in terms of the size of a failure test?
Yeah, it matters a lot. But one of the things that, and this is one of the ways that my thinking has evolved since the book, and you can Google my name and then reversal complex, the phrase reversal complex. So sometimes those failure tests can evolve over a couple bars. So you might, for instance, have a fairly big bar that closes above the level and it looks like a good breakout. And then you have a reversal back down the level. So you have this like white and black, or green and red, whatever colors you start. You have that pair of candles. And in this case, if they're both a little bit bigger than, say maybe bigger than 1.5 ATR or something, those would probably be better signals. So I think you do want to see. What you really don't want to see is that you have this failure test and it goes like 0.5 ATR above the level and then closes just right. That's not it. There was no, people didn't get hurt there. You want to see a level where traders made mistakes. Traders got hurt. You want to see volatility that's going to be reflected in, I don't need to look at volume. It's going to be reflected in the range of the bar. So you're absolutely correct. You're going to see bars that are, I would say, at least an ATR. And in reality probably bigger, probably more like 1.5. On the other hand, if you have this gigantic reversal, the move might already be done. If you have like an 8 ATR bar, well, it's more likely than to mean revert back up toward that. So there's definitely with if we just tell people go look for big bars, somebody's going to find that gigantic bar and they're going to sell the bottom and it snaps back and they say these guys are idiots, they lied to us. But it's all all of this stuff, there's kind of a sweet spot in the middle where it's not too much of one thing or too much of another thing. It's a good question. These are really good questions.
Happy to hear that. Okay, let's move on to the second pattern. I think trend continuation, right? Flag patterns is, I would say it's one of your favorite based on following you for a while now.
It is, yeah.
So I think for some of those listening or watching this video right now, they may not have a good idea what exactly is a trend continuation pattern. So I'll let you explain on that.
So a trend continuation pattern is just a pattern that you have a market that is trending. So it can be an established trend, or it could also be a market that has been sideways and then makes an upside breakout. And what you're looking for with a trend continuation pattern is some kind of pause that tells you that market's likely to continue. These go by a lot of names. People talk about flags and pivots and wedges and rectangles, and the classical charting people, which I really kind of have issues with that approach, but they have a lot of different variations. I don't think it matters. I don't think it matters what you call them, what they look like. And I used to think it did. I used to tell people, you got to look for the best patterns, and you've heard that. You've heard that thousands of times over the years. And so what's the best pattern? Well, we can think about what that is, but it's probably a pattern that's kind of symmetrical, like it's pretty on the chart. And so I sat down one night because I had bizarre hobbies, and I was like, okay, so this pretty pattern thing, like your A+ trade setups, how big is that edge? That was what I sat down to figure out, like, just exactly how much better are the really good looking patterns than the others. So I went through, I don't remember, a decent number of trades, 800, maybe 1,000, and separated them according to the visual quality of the setup pattern. And I discovered there was no difference whatsoever. No, it added nothing. So now obviously there's some, there's some point where the pattern becomes not a pattern, right? So like if we're looking at a pullback and I might say, oh, it's a flag, it's a bull flag, it's a bull flag. And now it's not. At some point, the pattern integrity is broken. And that's a little bit of a judgment call. You and I might have different spots where we would make that decision. But what I have discovered is that as long as the pattern fulfills my requirements for what the pattern should be, it's an A+ trade. And it doesn't matter how good it looks on the chart. It might matter if I want to take a picture of it. And I could be a little cynical here and say, if I want to take a picture and tweet it or show people, write a blog about it. In reality, there's probably something to that because those pretty patterns encapsulate the ideals of the pattern. It's like the platonic ideal of the thing. Here's the perfect pattern we should be looking for. But, it's also important to realize that this can end up in a lot of distorted manifestations in the market, and those patterns are still absolutely valid.
So when you trade trend continuation patterns, as you said, there are multiple variations. One could be the bull flag pattern. One could be sort of like a quote unquote failure test at the lows of a bull flag, and one could be just trading the breakout of the bull flag. So maybe you can walk me through a few scenarios of such a trend continuation patterns and how would you trade these different variations?
So it could even be a single bar. We just had a very good example. I think I know what date it is, but just to put, so this is Tuesday, November 14th, 2023. If you go back and look at the S&P futures, the 24-hour futures, and you look at the previous day, you will see that the previous day's bar was a very small bar near the top of a relatively big bar of the day before that. So in that case, that single tight bar near the high of a previous big bar was enough of a consolidation pattern. And of course, we can get into all kinds of multiple time frame stuff. If you go down, look at a 4-hour chart, it was a clear bull flag. And so, there are all these different ways to see the patterns. But what I want to know, first of all, is I want to be reasonably sure within the range of, and of course, we're not sure about anything, and I will qualify everything I say over and over and over again. So I'll try not to do that. But I want to be reasonably sure that the trend is not likely to end, which is not the same as saying that it's going to continue forever. But I'll look for patterns like exhaustion, or one thing I'm a little concerned sometimes if a trend is mature. If we've had like 8 really nice trend legs, well, is this really, is this what we should be thinking about? If the market has been downtrending and then makes really good momentum to the upside, I need to be sure that that momentum breaks that downtrending pattern, and now I can maybe look to trend continuation to the upside. So that's the first thing I want to know. I want to know that there's some reason for thinking, I'm going to try to say it because I don't think I said it very well, some reason to think that the trend should continue. And this is going to be primarily good momentum in the direction I intend to trade. So if I'm buying, I'm looking for a market to make a big move up. And I'm not going to feel like I missed that move. I'm looking to short. I'm going to look for the market to have a big sell-off. And that's number one. Number two is I want to be reasonably sure there's no reason that move should fail. So if it is up against a really clear level where we had a former exhaust, I'm talking about with a failure test, I might be a little bit, I won't say afraid, but a little bit concerned about that trade. So if I have those two things, then what I do as I switch into the mode of watching the consolidation and assessing the character of the consolidation. And that's very, very important. I want to see that so the market's made this, let's talk about a long trade, market's made this big move up. I want to see that it doesn't sell off that much. If it makes a big move up and then spikes right back down, okay, well, that was fun, and there was no trade there, nothing to do. If instead, I'll characterize it as a reluctant pullback. That's how I'll tell, the traders that I work with will look for a market to make a reluctant pullback. And, it can just be a single bar. It can take multiple bars. It can take 20 bars. And there's a little bit of a, assessment of that at every point. And then what I look to do is to enter when the momentum turns in the direction of the trend. Almost always. There are some times where I might position, because what trend are we talking about, right? This is what's confusing. You talk about trend. Well, you have a market that's made a move up, and then it starts to make a pullback. What's the trend? At this moment, there is a little bit of a downtrend, right? But it's a downtrend within that context of the uptrend, and we think the uptrend is going to continue. So there are times where I might buy in, not very often, but I might buy into that declining trend, at least a partial position. And one of the reasons is that I can read the market a lot better if I have on a very, very small position. Just having P&L fluctuate, having some involvement engages a different part of my brain that is more effective than just looking at a chart. And, there are times that I'll buy into, I was like, this doesn't feel right now, I'll get out right away. But I look to enter when the market turns back in the trend direction. And I'm pretty good at using trailing stops, look to tighten my stops pretty aggressively. But you can't, there again, it's a sweet spot. You can't be too aggressive because you do have to give the market some room to move. If you tighten too quickly, what you'll end up doing is accumulating a constant string of very small losses, which add up to a big loss.
Okay. Yeah, we can talk about trailing stops later on. So you also mentioned that you like to buy when momentum is present, meaning that the trend is about to resume itself. So I think a couple of ways you can do it. Number one is maybe when the price breaks above the bull flag, that downward trend line, which I think someone can just draw.
Yep.
Another one might be breakout of the pivot high, the swing high. That's another option.
I'm not so crazy about that one because a lot of times I'm looking to actually take partial profits there. There are times I will do that, and there can be a kind of consolidation that's like flat up against that. But generally speaking, I want to buy a little bit lower in the flag. So, maybe a breakout of a previous bar. It's great if, again, you can't choose the gifts you get, but when the market gives you like 2 inside bars, taking a breakout of that next bar in the trend direction can be good. And also, sometimes it doesn't work. Sometimes you get the best breakout level and then that breakout fails and you have to kind of decide if you want to reset and try the trade again. But generally speaking, I would not look to buy the previous pivot high.
Okay, so it's more of breaking out of the previous bar high, or maybe a mini downward trend line that someone can draw for the bull flag pattern. Okay, So when it comes to entry, there are a couple of ways. You can wait for the candle to close, or you can use a buy stop order, which is usually your preferred method.
Usually the buy stop order. I've done it both ways, and I traded an approach that worked for many years, worked pretty well, that was based on executing on the close. And what I would practically do is not execute on the close, but I would try to execute on the next open. I wasn't trading such tight consolidation patterns. What happens a lot of times, if you wait for the close of the bar, enough of the move has happened that the trade is already over. So you can make a trade, but it's a different trade. It's not really the trade that I'm looking to make. So I'll generally enter on a stop order, or sometimes I'll have alerts set and do manual execution.
And earlier you also mentioned that sometimes you enter on a pullback, right? Like for example, you give the example of a failure test at the lows of the flag pattern. What about moving average? Do you like maybe wait for a pullback towards a moving average, like the 20-period moving average?
I mean, the problem, so I do have on all my charts, I have a moving average and Keltner channels, and I've changed the setting on those a little bit over the years, but it doesn't matter. It's just, a little bit of variation, I think, to keep my eye fresh. There's just no statistical edge to a moving average. And I know that people publish a lot of work showing the opposite, but I mean, face it, if it worked, you'd just run a system that was like buying at the 19-day moving average or whatever and be done with it. Like, you wouldn't need to do system development. So I am aware of a moving average as it does show that the market has retreated from an extreme. So I won't tell you that I never buy when the market comes to a moving average, but I don't think I don't know. I don't think I've ever executed at a moving average any time in the last 15 years. So, okay, maybe I can tell you I do that, but I'm aware. I'm aware when we come into the moving average that we come back to the moving average. But I'm also very, very aware from my statistical work that I have to be careful to qualify that and say, hey, there's no edge to this. Like if I make this trade right on the moving average, that's not a trade. There's no statistical edge there.
Okay. So let's move on now to the third pattern, right? The complex pullback. We talked about that a few times earlier. So I think it'd be great if you just give a brief explanation of what this pattern is before we dive
that's
deeper.
Probably a pullback where you lost money already. So what happens is the market goes up and makes the pullback and then turns to the upside enough usually to get people like me to buy the market. And then the market turns back down. And many times will make a lower low. And there are many times that you'll be stopped out of that. Now, these do tend to occur. There's some degree of probability here that if there's an urgency to the market, so say you just had a big breakout or a big trend reversal and then new upside momentum, you will tend to not see complex pullbacks there. You'll tend to see simple pullbacks. But if a market has been in a more mature trending phase, or if it's done a kind of a parabolic move, a little bit of a parabolic move, then a lot of times you'll need a complex pullback to kind of absorb that. So in those moves, what I'll do, I won't take the simple pullback because I'll think I know the game here. I'm not going to participate in this game where I lose money. And of course, sometimes you'll do that in the market. You'll say, I'm not going to take the trade, and the market just explodes. And you can't be bothered by that because one of the aspects of this, I think, that's so important is, and why thinking in probabilities is so important, is because you just realize you literally cannot be right all the time. And I think a lot of traders beat themselves up for trading mistakes that were actually not mistakes. I've seen people do elaborate trade review of things that were just not their mistake. Like, it was just simply a losing trade. Why are you agonizing over it and figuring out how to avoid it in the future? It also works the other way. You had a big winning trade and you just got lucky. So the idea of figuring out how to do more of those trades might not necessarily be the right thing to do. But the complex pullback is, I think I hinted at this before, and I said with the failure test, you want to look for enough volatility to show that people got confused or traders got hurt. And it's kind of the same thing in the complex pullback. You want to see the market made an attempt to resume the trend, that attempt failed. A lot of people are probably just disgusted and walked away, and that sets the stage for FOMO when the market turns back to the upside. All those people who were kicking their, waste paper basket a minute ago, now they got to get back in the market. And because I already knew how the pattern was going to work, I am already long, and now I can sell it to them when they start to get itchy fingers on their mouse.
So when you say that you are already long, which part of the complex pullback will you be looking for your long entry?
It's great if you can get a failure test at the bottom. It does not happen that often. I don't think you can. I don't think you could build a trading career around just that idea. It's one of the best trades out there, but it's quite rare. What I'll do is, so you have this first move up, and then you have the failure. So you got to watch that failure. What happens on the failure? If it fails and then it accelerates to the downside, the bears really start winning. Well, okay, so there's probably no trade there. But if it goes down and then kind of stabilizes, then I'll start to look for ways to get into the trade. And I'll say, maybe we'll get some volatility compression, an inside bar or something, or, some kind of little double top within the pattern that we could then take a breakout of that. So I'm looking to enter with the momentum to the upside. I really am not interested in, I'll rarely do it, but I'm not really interested in just buying that second leg and hoping for the pullback to work. I want the market to show me something. I want to see that there are bulls interested in this market. And so the way that shows up is the market makes a move, and that means that I'm not entering at the best price anymore. I'm not entering right down at the bottom. I think one of the things that a lot of traders struggle with is they want to use really, really tight stops. And, I guess you can do that. I knew a trader who, I didn't think it would work, but he had traded a fund tens of millions of dollars, as a small commodity fund, but his win ratio was something like 11%. which is horrifying. But what he would do is he would basically get into a trade and just give it no room whatsoever. If it didn't work, he would get out. And on the ones that worked, he was pretty good at trailing a stop, and that worked out for him. Now, the problem with that approach is, with the way I trade, which, winning a little bit more than 50% of the time. It's not like 80%, but it's not 30. I don't really have to take every trade. That's one of the other lies that, people tell you, oh, you got to take every single trade because it could be that one trade that makes your year. Well, I gravitate toward and I strive for consistency. So no one trade is going to make my year, but one trade could. Can I swear here? Like, what are the rules?
There are no rules, though.
Because I generally have a pretty foul mouth. A year in a professional kitchen, and then on some trading floors, will do that for you. But I do know that. But I try to restrain myself because I never know who's listening. One trade cannot make my year, one trade can fuck up my year very badly. So I always know that no matter how long I have done this, no matter what I've done right, no matter how much money I've made, I could really destroy myself with a single trade if I got stupid. So that answers a lot of the discipline problems. Just knowing that you have this sword hanging over your head by a hair, it keeps you from getting stupid. But what he had to do, because his win ratio was so low and his wins were so important, he did have to take every single trade. And the end of his story, I don't actually know what happened with this trading, but he had a few cases where he missed two trades that really would have made either one of them would have made his entire year. And this set off a chain reaction of psychological issues. So I do think there's some vulnerability with trading those strategies that are a very low win percent and very big wins. It's why I've designed my life otherwise. But I am not going to use a super tight stop because I'm going to wait for the market to already be moving back in the direction, and then we'll see if it's right. Some complex pullbacks have 3 or 4 legs, and then it becomes a question of how many times am I going to do this? And sometimes you give up right before it works, and sometimes you get it the third time.
Yes. So from what I'm hearing, the complex pullback, again, you like to see momentum moving back in your favor before you look for an entry. And of course, the stops is not so tight.
Right.
Let's say if you were to look at a complex pullback on a daily time frame, it would probably be like, I'm guessing, 8, 10, 12 candles. And it can be hard to see the price action because it's all on the daily time frame. So were there instances where you go down to a lower time frame, like the 4 or 8 hour time frame, to
Not
get a clearer
really.
perspective?
Not really. That's to me. To me, that's not necessary because I can see it on the daily time frame. When you said you can't see the price action, what you mean, or what I think you mean, is like you don't really know what's happening inside those candles, right? You don't really know what the character of that market is. This goes back to my I'm going to make the trade on the daily time frame, so I'm going to assess the market on the daily time frame, and in most cases, all of the information is there. The times that I will go down to a lower time frame, like when I'm showing the traders that I teach an example, I might go down to a lower time frame to show them price action. And by the way, sometimes I do like all of this work out in the open. I generally don't prepare much in advance, so there are times that I'll be like, oh, look at this nice little consolidation. This hides a lower time frame consolidation. Then I'll punch up an intraday chart and I'll see, well, shit, it doesn't. What I thought would be there wasn't there. Those sorts of things happen sometimes, but generally, you said 8 bars. 8 bars is probably a really short complex consolidation, but it could happen. I would say you're probably looking at 10 to sometimes even 20, 25 bars. And what happens is there's kind of an interesting situation. It's not a complex consolidation, but there's this really long, slow drift up in orange juice futures right now. People can check the date if they're listening in the future. And I don't know how it will resolve, but orange juice have been in a big uptrend, had a big blow off candle at the top and then reversed down. And now it's been making this little bounce up. It's gone longer than I think it should go, but I've learned over the years that a lot of these pullbacks, this is one way I think the market tries to kind of trick people. These pullbacks will go just to the point where you stop watching them. And I've seen so many times that I'll be stalking an entry, I'll be working my entry orders, and I'll be doing this for a few days. And I'll be like, are we really? Okay, it's not going to happen. And then, of course, the next day is the day that it goes. So what I have learned is that I nudge things just a day or two past the point where I feel like I should stop working or stop watching that market, that tends to kind of be a sweet spot for some of those breakouts. Some of them can go on for a very, very long time.
And let's move on to the final pattern, the anti-pattern, right? So yeah, please tell us more about it.
Well, so I also wrote about breakouts, but we've been talking about those all along. And I think, the kind of cool thing about the breakout is, maybe you did this deliberately with your questions, it's nested in all of these other things that we're talking about. It's an element of all of these other things. So the I recently have renamed the snap pullback. This is going to be a little bit hard to describe without charts, but the anti is a pattern, and you can Google it. The term comes from Linda Raschke's book, I think 1996 book, Street Smarts. It was her and Larry Connors, I think, wrote the book. There's a trade in there that was based on the slope of 2 indicator lines. So you would have the long-term line would turn down for the first time. And so what that momentum is indicating is that a longer term trend is just turned down. And then you would have the short term line would pull up against that. So anti, they're going against each other. And what this shows is that the longer term trend is shifted to the downside, and we're assuming the market's going to resolve in the direction of that longer term trend. And the fact that the short term momentum is against it gives you maybe a little bit of an entry edge. What I found over the years is I don't use the indicator that much. I don't use the only way that I use an indicator, frankly, is to teach and to illustrate momentum. So I can say, oh, this market made a big move, and you can see it on the MACD. I didn't see it on the MACD. I saw it in the price structure, but having an indicator can be a really great way to structure this. So I found myself not using the indicator, and I found myself using trades that would occur in the price structure with that concept that did not show up on the indicator, and furthermore, ignoring ignoring many points where the indicators signaled the trade. So at that point, it's like, why are we even calling this anti anymore to begin with? So the other beautiful thing about this trade, and I do think that this is a trade where I've known several people over the years who have built a trading career just around this pattern. It's not that common. But the way that I rethink it in the snap pullback, it's not substantially different, but it's this idea of looking for a trend that is exhausted, the first momentum against the trend. That was always in, if you read Street Smarts, and you should read the book. The book is still in print, so you should go buy it rather than pirate it. I hate all the pirating stuff out there. You should go buy that book and you should read it. There are good ideas in the book, good ways. It's a good framework to think about the market. This was always in that, but that idea of focusing on what's happening with the price structure really became the primary driver for the trade. And when it works, it resolves really fast. It's the best feeling to be in those anti trades, or as we're calling them, snap pullbacks. So I named it snap because of the way the resolution is so sharp.
Yes. So from what I hear, you're looking for like a trend to show like a sudden swift reversal, maybe followed by maybe the uptrend, and you got a sudden one big candle reversing, right? Maybe the last 2-3 candles of gains. And
Yes.
then I think the next thing you're probably looking for is, if I'm not wrong, a pullback again, right? A
Right.
bear flag maybe, right?
Right.
And
Exactly.
taking into account that, hey, this downtrend could possibly resume down lower.
Right. The difference, one of the differences, that's exactly right. One of the differences between this and a standard pullback is a lot of what catches my eye is a standard pullback. The market will have to make enough momentum to get to one of the Keltner channels that I use. So you can almost use that as a trigger for when to, not for a trigger to enter, but a trigger. I want to be very clear about that trigger for when to start looking for a pullback. So if the market is able to come down and touch the lower Keltner channel, I will then watch for those bounces to set up bear flags. It's not 100%, but it does, when we're talking about pullbacks, to say I want to see there's real momentum. It's a way to quantify the momentum. What you will see with the anti or the snap pullback is that many of those will actually set up around the moving average. So you've had this market that's been trending up. It's volatile, so the bands are wide. You will have this giant reversal that maybe takes you, so maybe the market was above the upper channel and now it's down below the moving average in 3 bars. So it's been a big move, but then this bounce starts that now goes back above the moving average. So you're kind of sitting here in the middle of the channels. If you're just evaluating it based on the channels, you didn't really have enough momentum to get to the bottom of the channel. So it's not really kind of in my standard pullback range, but that move, that collapse from the trend extreme did set up enough momentum that you should have continuation. That's what really makes all of these continuation patterns work, is that I'll go back to assessing character. You want to assess that the move that sets up the pullback should have continuation. I've said that before. I'm deliberately repeating myself. And then you want to assess the character of that pullback is a reluctant move against that momentum that you just had. And you can see that it's very hard to talk about, but if you I have lots of free blogs and things you can look at to see. Once you've seen a few examples of it, and you did this yourself, once you see a few examples, like, okay, and then you kind of go and you start to see it in the market, and like anything else, you'll make some mistakes at first. And one of the things that's hard, of course, is that some of your mistakes are not actually mistakes. It's very hard because I could teach you this pattern and you could find what, to my eye, is a perfect example of the pattern. You could put the trade on perfectly and lose on the trade. You made no mistakes, but you lost on the trade. So this is one reason why it takes a while to learn to trade. You have to have enough exposures, so you start thinking in probabilities and intuiting probabilities rather than individual events.
So I think we spoke a lot about patterns and entries in the earlier section. So now let's move on into the other aspect. We talk about trade management and stop losses, right? So maybe let's talk about stop loss first, because that's also very important, right? Besides your entry. So I think stop loss, if I'm not wrong, right? After following your work for a while now, your stops are usually just below the pivot low or the pivot high. Did I get it right?
Yeah, there's a little bit of room, but I'm usually outside the pattern. The exception to that is the failure test, where if you go back to that failure test, you went up above the so we're looking at short, you went up above the level, and then you collapse. I will usually put my stop inside the high of that bar.
Could you expand more on inside the high of the bar? You mean just above the high or below
No,
the high?
no, I mean literally. It's counterintuitive, right? I will put it literally below the high of that bar, so I am inside that bar. And the reason is because, frankly, if this trade works, it's going to work pretty quickly. If we start to work back up into that bar, we really should not be there. The trade's probably not going to work. And what you will find in some cases is if my stop is outside the high of that bar, there are very, very few cases where the market will come right back up to that high of the bar and then reverse, and I have a good trade. Usually I'm fucked if we get back up to the high of that bar. But if I have my stop outside the high of that bar, what I'm inviting is to get hit on really good momentum and have really bad slippage. Or if it's the daily chart, to have a gap opening above that and then end up with like a 2-hour loss on some stupid trade that I knew wasn't working to begin with. So I will, in that particular case, and this has actually gotten me a lot of hate. I have some people online will be like, that's a really stupid thing to do. You don't know anything about reading price. Okay, I guess whatever. But that's a counterintuitive thing that I think makes sense. I think it's not so counterintuitive when you actually think about it. For consolidation patterns, my stop will generally be outside of the pattern. So if I'm buying a bull flag, the exception might be if something weird has happened in a complex pullback, because you can't have a complex pullback that like kind of begins to turn in the trend direction. So it's set up some price structure that's actually above the low of the pattern. So I might then work off of that. But my goal is not to get the tightest stop possible. I'm also not looking for a really crazy wide stop. I don't need to give up a lot of room on that. A little bit outside of the pattern. And then I will look to tighten the stop aggressively. And I think that this art of it's something that I have a lot of limitations as a trader. There are a lot of things that I could do better, that I wished I did better. But I think one thing that I do really well is this discretionary trailing stop approach. And the only way I found to teach it is through multiple exposures. Like, you show people a bunch of trades and you say, here are the trade management decisions I would make, and here's why, and you kind of talk through them. And over time, it kind of becomes like an apprentice thing. People see this working. But the principles are that, so I'll get into the trade, and right away, what I want to do is reduce risk. Now, I'm not thinking that I want to get to a break-even stop, because a break-even stop is like, it's just some number I made up. The market doesn't actually know that, No, in some cases, maybe I took my trade at an actual breakout level and the market does know it, but let's assume the market doesn't know it. And it keeps us humble to say it's just kind of a level that I made up. So there's no necessary goal to drive toward a break-even stop. But what I will try to do, let's say the kind of uncomfortable thing happens that you buy a breakout of a pullback, and then the market just sits there. It doesn't go anywhere. So in that case, what I'll probably do, and I don't know, I haven't evaluated my stops in terms of ATR in a long time, but I'm guessing my stops are probably 1.5-ish, maybe 2 ATRs, just to give you an idea of what they would be. So what I will, and I think of everything in terms of R being and I think a lot of people think like this now, but just in case anybody isn't up to speed on it. So R being the initial amount that I'm risking on the trade. And we could express that in dollars. What R really is, though, it's the amount of movement on the price chart. That's how I think of R geometrically, but then we multiply it by position size to get your, the P&L impact. But what I'll try to do, I'll just make some concessions if that trade doesn't go anywhere, which is really a little bit unusual. I'd say maybe 20% of trades do that. I'll tighten stuff like 0.9 R or 0.8 R, if just to take a little bit of risk off the table. So I probably won't have a 1 R. And you have to say probably because you get slippage or whatever. But once the trade moves in my favor, Once there is a really big bar in the direction of the trade, which of course is really nice, then I'll move my stop up into that bar. And one of my rules is I will very rarely move the stop in the direction of risk. So I don't widen the stop. I'm always tightening the stop. There are some times that maybe I'll make a decision and the next day it'll look like a mistake, and whether it was a mistake or not, I don't know. So I would say it's quite rare, maybe 2 out of 100 trades or something. Maybe I have a case where I widen a stop a little bit, never past the initial stop. Just like maybe I tightened it too much the day before. And there's a little bit more to it, but that's the idea. Basically, when the market starts to show me good momentum in the trade direction, I'll start to tighten quite aggressively. Also, one of the things that has worked pretty well is to just take full profits at 1R, which takes a lot of the trade management issues off the table because of course, you'll never have big wins, but you'll be driving toward more consistency there.
Okay, so maybe just to backtrack a little bit, from what I'm hearing, you said that if the market doesn't move in your favor, your stops, you just kind of like just tighten it, right? Maybe by 0.8 or 0.9 R just to manage your risk. And if it does move in your favor, let's say you get a momentum candle, assuming a bullish long trade, you will tighten your stops or trail your stops using the low of that recent momentum candle.
Not necessarily the low. Sometimes I'm in the bar. Sometimes I'm a little bit beyond it. There is some consistency to it, but a lot of time, if there's a very big bar, my stop the next day is in that bar usually, maybe in the bottom third of that bar.
Okay, is there like an objective way that you quantify which part of the bar you set your stops, or that's discretionary?
It's discretionary. I think I'm pretty consistent because I have thousands of trades, and all of these are a lot of these are recorded publicly, so people have gone back through and evaluated. And I am consistent, but I don't think it can really be reduced to a rule set. I wish it could, especially as I think about more systematic approaches. I'd love to systemize it, but I think there has to be a discretionary input to it, unfortunately.
Right. And earlier you also mentioned that your take profit level, it's I think almost at 1R. Is that like regardless of the price structure on the chart, whether is it at support resistance, right? Probably that's quite a subjective level. So do you take into account price level or just flat 1R take profit for most trades?
I am aware of price level, yeah, and I'll structure the trade around that, so there's no huge issue with that.
Okay, so in other words, your 1R is would be, let's say for example, resistance. You'll be below resistance and not above it, right? Because if that's the case, the market has to work harder to reach your 1R.
Generally speaking, yes. Yeah.
Okay, I get what you mean. Awesome. So I'll talk about a little bit about a post I think you made on Twitter and Facebook, right? I saw you posted a bull flag pattern on the S&P 500 on the 5 minutes time frame, right? No surprise since you mentioned day trading earlier.
Right.
So when you're trading on an intraday basis, from my understanding, the opening and the closing is more volatile compared to say the noon session where traders are away for lunch. So let's say you have a potential day trading setup, maybe trading the bull flag pattern. Does the time of the day matter when you take your entries?
I find that I tend to be pretty consistent through the day. So you have different expectations that follow through at different times of the day. But I've never really been a trader who just trades the first hour or something like that. So I think there's opportunity spread through the day.
Maybe back a little bit to the take profit level. So let's say this time around you enter a trade and the market is really bullish, right? At all-time highs, there's no price structure that you can reference from. Is it still going to be a 1R take profit, or you might have a different approach to that?
I might have a different approach. I think there are times like we've been doing have been doing over the past previous weeks and months, I guess, even a lot of shorts in stocks and stock indexes. And my sense has been that those shorts are counter to the bigger picture potential. I expect the market to reverse and rally. So in that case, I've been very aggressive about taking 1R profits on the shorts. This is not a case where, I was looking for stocks just absolutely collapse and continue to sell off. Now, however, that we've turned, I think it makes sense to stretch profits on the upside. And you can do that lots of different ways. You can take partial profits at 1R and then trail on some, or you can just trail a stop. But I definitely, and I guess this is a kind of multiple time frame analysis that if it's not explicit, it at least is baked in there that I'm making some kind of assessment that based on the price structure on the monthly or weekly chart, that I think the daily trend has more potential in one direction or another. So that's absolutely something that I am aware of. Yeah.
And judging from what you said, right? You trade off the lower time frame as an intraday trader as well as in the higher time frame. So you have experience trading across these different time frames. But for people who are maybe a year or less in trading experience, there's going to be difference across these different time frames. What's your take on it?
I honestly don't know. I think that everybody wants to be a day trader, of course, but I think day trading is the hardest trading to do for so many reasons. And over the years, I've had hundreds of traders tell me something like, I tried to day trade, I tried for years. As soon as I moved to a swing trading approach on the daily time frame, I did so much better. And I also had, for many years, I did a lot of work with institutional clients, and some of that, a lot of that, I still can't talk about. But these were traders. This is both discretionary and systematic. I sold trading signals to a lot of hedge funds whose names you would know. They would buy algorithmic signals from me to then deploy in there, which is funny that I haven't done much systematic trading, right? I've developed systems for them. But I would have many, many conversations with these teams where they'd be like, what time frame do you trade on? And I'd say, well, I did everything. And, but I found really the sweet spot's kind of like 2 days to 2 weeks. And time again, I heard, yes, us too. So, and these teams had, in some cases, literally dozens of PhD level quants crunching numbers and doing things. Now, of course, there are some funds that do HFT, and that's quite a different thing. But I think if you're making systematic approaches, there's probably objectively a better edge, a little bit easier to conquer the psychology of trading on the daily time frame. But, I would not tell a new trader to avoid day trading. I would remind them with constant caveats that the statistics overwhelmingly say you're not going to make money as a day trader. Maybe you're the exception, but as long as we can be crystal clear that the deck is very much stacked against you, I think you can approach it as a learning opportunity, because the advantage you have as a day trader, you got to make a lot of decisions. Even if you're a slow moving day trader, you're still making 2 to 3 trades every day. And you're taking those trades from conception to completion, where if you're trading on the daily time frame, you might have to go a month to get that much, or maybe even longer. So and of course you can trade more actively. You could do 10 to 20 trades a day. So theoretically, there's an advantage. I think that this is something that I certainly benefited from, but I do think that a lot of people, you can develop a lot of bad habits. You can develop a lot of bad psychology day trading. As you can tell, I don't have one clear answer to this, but I think it's very important for somebody. I think the only way that I would really raise red flags is if somebody thought they were going to start trading as a day trader and make a lot of money very quickly as a day trader. You're still going to struggle for years. And I would bet if you do find success as a trader, it probably will not be as a day trader. But it doesn't mean you should not try to climb that mountain, because who knows?
All right. Okay. So maybe away from day trading, let's talk maybe generally about discretionary trading. If someone wants to get better at discretionary trading, there are many ways they can do it. They can stare at the charts all day, journal their trades, read more books, courses, etc. So if you were to maybe start over your discretionary trading career over again, what would you do differently, or how would you approach it?
Are you going to edit this, or is this going to go up in one continuous?
I plan to just upload it as a 2-hour show in this case. Yeah.
So the reason I ask is I don't necessarily want to plug a course, but I recently have created a course to answer that. Do you want me to talk about?
Yeah, please go ahead.
Okay.
There's no worries. Yeah.
So I've thought about this for years, and I got. I put out so much material to teach people how markets move, to teach people how to think about the market, how to think as a trader. But what the questions I kept getting, people would say like, okay, but tell me just what you asked, like, what should I do? How do I develop the skills of being a trader? And I had pieces that I had used over the years, training traders. I did a lot of work with, when I was at the New York Mercantile Exchange and I left, a lot of the floor had completely closed down, and there were a lot of floor traders who were trying to make the transition to the screen. So I helped a lot of those people, and a lot of them, frankly, couldn't figure out how to make the transition for different reasons. But I had worked with so many traders that I had this framework that I finally this year put together into a course that if you want to see it, I'll give you access to it. Just email me. I'll set you up. This is the best thing I've done training traders by far. So what we do with this is we approach the problem from several directions at once. The first thing is I am convinced that many people struggle as a trader because they're trying to do something that is not right for them. They're trying to, I'll tell you a story. I had a guy who wanted to trade the NASDAQ futures. He was very specific, and he wanted to trade very actively on a 5-minute chart. And he had a job. This was the problem, where he could escape into a closet, literally a closet in his office where he had a computer and he could day trade. Now, his problem was that he was a safety manager for a steel refining plant. So, I said, I can't work with you because we're going to get somebody killed. There's just no way. So you see people who are trying to do things that are incoherent with their lives, or frankly, people who have like deep-seated issues with money or self-worth and all of these things. So I think one of the things you have to do, and I know this is not, people just want to learn the patterns. You want to where do I push the damn button? But, we approach this, first of all, from the standpoint of doing a lot of introspection, a lot of thinking about what has brought you to this point in your life, how you want to structure your life going forward. I also included a lot of work with meditation. I think a lot of meditation I'm utterly convinced, is not the solution to all of your trading problems. There are certainly people who say, all you have to do is do mindfulness meditation and you'll trade better. Well, that's not true. It's obviously not true. Just because there are a lot of people who are fantastic meditators who could not make a penny trading. And it's obvious there has to be something else to connect the dots. But I figured out this framework that will connect it. And then what you do is you cultivate pattern recognition by these questions you have asked me about these patterns. My real answer to you would be, if you were asking me as not the experienced trader you are, but as a beginner, I would say, okay, let's learn these patterns. Now you spend a lot of time. What's a lot of time? 40, 50 hours, maybe. You go through hundreds of charts. You find examples of these patterns historically. So we're training your pattern recognition. And we'll do this with several different patterns, and you will start to write your own trading book. So you'll have these examples of patterns. We're not done yet. The other thing that we will do is this issue of random outcomes that we discussed. So you will start with, I have a deck of cards here on my desk. This is a key part of the program. We start working through decks of cards, seeking to understand what random outcomes feel like. And so you'll generate strings of trades. We'll weight them in different ways. I have this set of 13 trading drills that begins with a deck of cards and then moves you to the point where you're on a trading simulator and you're generating trades with a deck of cards. So think about what that does. The problem for the day trader is you have a system. You fund the account. You do a little bit of work on the demo, and they are like, okay, whatever, we know how the demo works, and then you're live. You do all of this work. You wait for your pattern. You wait diligently. You see a trading signal. You put on the trade, and you're all nervous. And then what happens? And then you have to manage the trade. But now the problem is that all of these other things are focused into your psychology. So you're not just managing that trade. You're managing your entire hope for your future success. It's very, very difficult. However, what if I tell you, pick up a deck of cards and you pull a black card. So you mash the buy button. Now, what analysis was involved in making that trade? What investment do you have in that trade? None, right? So now your job is manage that trade. And then, once you're done with that trade, you pick another card and there's another long, the card's black, so you put on another long trade, and you put on a short trade. So what we're able to do is to separate aspects of trade entry and trade management. And there's this whole very disciplined framework where then we also turn it around. And now you've been doing work on pattern recognition. Now we use that to generate trades, but you're not responsible for managing them. And also you can see here that for many traders who there's this idea of a gray box system. Do you know what that means? Is that a term you've run into?
No.
So a black box is a system where there's just computer code. You don't know how it works. It tells you to buy or sell, and those never work very well for people for very long. Generally, a gray box is a system that will give you an entry signal, or you might be able to work it the other way, and you manage it as a discretionary trader. This is an aspect of blended systematic discretionary trading that a lot of professional traders use, but people don't think about it because they think either I have to be fully systematic or fully discretionary. But this is this lets people experiment with both of the sides, and some people will find that they will in fact gravitate toward some kind of gray box where at least part of the trade management, and you could do it the other way, right? You could look for your bull flag and you could enter your buy signal, and then you could hand that off to some kind of, and a lot of platforms have this, right? Some kind of trailing stop methodology that will take the trade management out of your hands. I worked with a trader for years where he was responsible for the trade entry and I was responsible for the trade management. And it worked beautifully because neither one of us had any attachment to the trade. He would do all of this fundamental work. You come up with all of these reasons to buy the trade. He would put the trade on. I would get it on my trading screen. Well, I have no investment in that trade. I'm able to look at it and evaluate very clearly good pattern or bad pattern. If I think it's a bad pattern, I just get out of it. We move on to the next trade. So this idea of being able to separate your responsibility for entry and exit. And then while you're doing all this, it's an enormous amount of work. This program done properly is hundreds of hours of work. You are also building a trading plan. And with all of this work that you're doing on yourself psychologically. I also am a professional hypnotist. That's another thing that I haven't really talked about much. We didn't talk about it all tonight, but so there are some tools in there for kind of reorienting your experience of risk or your beliefs about trading, and all of this together. This is the best framework I've ever seen for training traders. It's not brand new, but it's been out a few months. We've had a couple hundred traders go through it, and the reviews are just outstanding. I expected this to be good because I knew when I was like, this is the best work I've done. This is better than the book. But the feedback that we're getting from people exceeds my expectations. So yeah, if you want to see that, drop me an email and I'll make sure you get access.
Will do. And where can traders find out more information if they want to learn more about the program you've just shared?
Sure.
Is there a link or website?
So you can go to my blog, adamhgrimes.com. You also can check out my company, marketlifetrading.com. Everything is linked there. Follow me on Twitter is a pretty good thing to do because I try to tweet everything. We are coming here into the end of November. We're going to have some sales. So, hang out for a week or so until we get our Black Friday sales out. We have some pretty good discounts. But I think my blog, if you just want if you just want one resource, there are hundreds of thousands of words on my blog. I went through and figured out if I printed it out, it'd be like a 2,000-page book. And of course, that's all free. It's Google has indexed it very well. So, I said before, there's no edge to buying at a moving average. If somebody thinks it's not a smart thing to say, well, if you Google Adam Grimes moving average, that's going to pull up 10 articles I've written where I'll show you the research that I've done. A lot of the statistical research that I've done is, I think almost all of it's available to the public. So you can see the work, you can see the numbers, and, I would love nothing more than for someone to show me something I've missed. And I've had over the years, I had some people say, "Hey, I don't think you're thinking about this right." And so, my thinking has evolved and grown from, because there's certainly people out there who have stronger math skills than I do, and it's great to get feedback from people. So yeah, check out my blog, adamhgrimes.com, and that program is called Tradecraft. You also can Google my name and Tradecraft, and that will pull up information on the program.
All right, and maybe just a couple of more questions before we close up today's session. Right, so a couple of questions that I'm curious to hear from you. So, what significant changes, right, have you seen in the trading industry over the last few years? Anything in particular?
Yeah, it's a great time to be a trader. The access to information, like even when I was trading, when I started trading S&Ps when I was trading the British pound, I was on a dial-up modem, and I had a separate phone line to call my broker or eventually to call the clerk on the floor. And I would put in trades. And so I would speak to a person to execute the trade. I was day trading a 5-minute chart. How did this happen? I don't know. But many, many times I would put in my order, and then I would have to call to get out of the trade before I got the trade confirmation back. In the early 2000s, when I started trading the S&Ps, brokerages, like, they would just shut down, and there'd be no tech support. But now there's so much information out there, and some of the information is not good, right? Because now there are a lot of people who are claiming to make money who don't actually make money, and there are a lot of people who are teaching things that just don't work. So you gotta kind of sort through that. But just thinking in terms of connectivity, you have access to pretty much for free to information that only insiders would have had 10 years ago. You have access to all the price data all over the world for very low cost, and transaction fee, commissions are zero in many markets. So I think it's a really, really good time to be a trader. If you're in the US, the micro futures are pretty liquid, and what it will, where before you might have had to try to learn to trade with a $20,000 account, now you can, if you limit your risk, you can learn to trade with a $2,000 account. So I think that's one thing. I think the new asset options obviously are becoming a bigger piece of the puzzle, and there are more possibilities for ways to trade options. There's more at the same time. I said there's some of the scam stuff out there, fake gurus, but there's also a lot of really good research being published. There are a lot of academics that are publishing fully legitimate research that you can just execute on until the funny thing is, when it's published, it usually stops working, but at least it can provoke ideas for you to research. There are people like yourself who are teaching people how to develop systems, how to manage risk, I think there is, there are people who are doing the work that you're doing, where you're advocating for a sane approach to trading that somebody can do over and over for a long time. It's not just about flashy marketing and a way to get rich quick. There are people who are telling the truth and telling it like it is, and I think that's that was a little bit harder to find when I started. It's not so much information.
Earlier, you spoke about you're more than happy, like for example, the moving average, you have data to back it up. But were there instances where maybe someone reached out to you, "Hey, Adam, maybe this is something that you're missing, right? Or this is my piece of research," and then that led you to maybe change your mind? Did that ever happen?
In some cases, one of the so we developed and we now publish something called power levels, which are based on geometric interpretations of short-term price action that are super effective support and resistance levels. And I try to really strike a balance between being open-minded but not being too easily misled by things. And and I looked at all of the levels that people publish, like, the Camarilla levels and the pivot, all these different pivot levels that people publish over the years. And I found that none of them had any statistical edge, but somebody sent me an email and said that in his work, he had actually found some edge to some levels that I had hinted at in my work and suggested that I do more research on them. And so that project was provoked by somebody who suggested I look deeper at something that I'd done myself. The one thing that I like, the Fibonacci levels, I also don't find any value in those. And it is interesting that you don't really get mathematical refutations of those. The people who email me about things like that will tell me about the great trades they made based on Fibonacci levels, which of course is not proof, and they'll talk about how mathematical it is, but they don't really have mathematical backgrounds. So, it's a little bit unusual. I also get, I get people sometimes send me manifestos of like trading ideas or like some secret they figured out. Somebody sent me something where they had tied cycles into some relationship with the pyramid at Giza. And so, you do get a good deal of semi-crazy stuff, but who knows? Maybe some people sent me some things that I missed the value of. But I find more than specifics, my interaction with people really provokes me to be careful and precise in my thinking. It's made me nailed down, and people have sometimes pointed out some things that I might be.
And also, I find that you're a pretty straightforward, no BS person, and with such a personality, is bound to offend people, especially if they hold certain beliefs that are very dear to their heart. So I won't be surprised if you get a number of hate emails coming your way, because you kind of crush their beliefs. So have you ever encountered such, emails, and how do you deal with that?
Oh, yes. Well, so one of the things that I know about myself, and again, this goes back to the tradecraft course that I made, we have people take a personality test early on. And I know from my personality profile that on basically like measures of politeness, I'm very low. So I think I'm like the second percentile in politeness. So it doesn't bother me to offend people. I'm kind of okay with that. But over the years, some people have gotten really upset. I got, when I was publishing macro research and institutional research, I correctly called the top of the gold market years and years ago. And I got death threats, more than one. More than one person thought that it was appropriate to send me an email threatening to kill me because I called the top of the gold market. And people, what happens, I think, like if I make a statement like there's really no objective edge in Fibonacci levels, people are more likely to be just dismissive. And they'll say, "Oh, that guy's stupid. He obviously doesn't know how to use Fibonacci levels." Or, of course, the famous thing you'll get thrown back is, "Well, you're just using them wrong," or maybe they don't work for you, but they work for me. Which there could be some truth to that too. But they're also, I guess, when it comes to doing quantitative work, the thing that I have lived by is that you can't have something that is both really significant and invisible in the data. So if you tell me that Fibonacci levels are super important, I should be able to structure some kind of test that shows there's some kind of unusual activity around Fibonacci levels. If I can't, if we keep going at this and what you can't come back and tell me is, well, you can't see it in the data. So it can't be both really important and invisible. It just doesn't work like that. Like, for instance, if you do intraday tests with Fibonacci levels, you're going to find they look like coin flips. If you do intraday tests around the intraday high and the low, you're going to find they don't look like coin flips. There's very definitely an influence there. And if you do intraday tests looking around round numbers, you're going to find something that's somewhere in the middle. It's not, and so that, okay, I don't really know how we think about that. You're not going to find something that's clearly statistically significant, but it at least shows some hint of, there's something granular happening there. And so, I try to think about trading problems in a scientific way, because when I put on a trade, that's effectively, every trade is a test of a theory. And if I put on hundreds of trades, if I had the wrong idea about the way things work, I'm probably going to lose money on this trade. So it's worth my time to figure it out. And I guess to figure it out correctly without losing money on it. And I guess I'm maybe more willing than a lot of people to not. I have tremendous respect for tradition. As a musician, I very much live in tradition. And you mentioned cooking. I'm trained in classical French cooking, and that's a very important part of how I think. And some of the, I cook Japanese and I cook Italian, and I try to, like, these traditions are very, very important to me. But I think in technical analysis, what we have, or in trading in general, what we have with tradition is kind of this mishmash of stuff that a lot of it just doesn't work. And so I am pretty willing to look at some deeply cherished belief of trading. And if I can't make it work, I'm not convinced that the person who wrote it was as deserving of honor as we might think, let's say.
Okay, so yeah, I've taken up 2 hours of your time, Adam. So before we go, I just want to do a quick recap. Where can the audience find you, just in case they go to the end of today's video and want to learn more about your work?
So check out my blog, adamhgrimes.com. You can also follow me on Twitter at adamhgrimes, and I do daily market analysis. You can find all of my courses at marketlifetrading.com.
Awesome, right? So thank you so much for your time today, Adam. I appreciate the depth and details you go, especially when we talk about the patterns, the way you manage your trade, your risk management, and very interesting to learn about your personal life, to know that you're actually born, in places where there's forests, there's trees, not like now everywhere is urban. And I've been wanting to ask you earlier, how it must be really good. I mean, at least from my point of view, to be around nature where the mind can just relax and not be around those high-rise buildings and cars, which is what I'm experiencing right now. But yeah, I think that was really beautiful to know that was the environment you grew up with, which is something that I think most of us are lacking right now, given the circumstance that we are in. Yeah. So anyway, thank you so much for your time again, Adam. I appreciate you. Thank you for being on the show. Take care.
This was fantastic. Thank you. So happy to be here. I'm honored. Thank you.
Thank you, Adam.